Rajesh Bhatia joins us, CIO with ITI Mutual Funds. Rajesh, the market rally of late has been nothing short of spectacular. What has led to the rally and will it sustain? Forget about going higher, but will it sustain at these levels?
No, indeed, Nikunj. It has been a phenomenal rally and quite unexpected given the challenges that we were facing probably in September. Even though not much money has been made since the September top, I mean, it's extraordinary how strong our markets are. Look, what I think has happened is that, India is still looking like a oasis in a world which is extremely troubled. India doesn't have macro challenges. You look at the US, Europe, China, Japan, everybody has significant macro challenges to navigate. India, on the other hand, is still going to emerge as the fastest growing economy in the world with the least macro challenges. In fact, I would say our macros are extremely strong. Low crude prices, low inflation, interest rates which are heading lower, very strong current account balances, fiscal which has been extremely well managed. I think that's you should commend the government for being extremely responsible with the fiscal. All of that, and the structure is in place. All of that means that the macro for India is extremely strong. It becomes one of the better markets in a world which is navigating the uncertainty of tariffs and the Trump economic policies. India stands out with only 2% exposure to US trade as a percentage of GDP. India definitely does stand out as a very attractive market. So I would say yes, left to our own devices, minus the global challenges that all equity markets will face, India is actually in a very, very strong footing.
Interesting you say that, Rajesh. I'm morning, so analyze the earnings for us. Let's look at the markets a little bit more myopically. What's the analysis? Where do you think lies the strength and the weaknesses?
So that's a good point, because one of the challenges, why did we top out? Because we topped out because the outlook for earnings growth rates definitely softened with the government expenditure, which was the key driver of GDP, slowing down. The outlook for earnings definitely came down. Now, look, margins have actually gone up very well in the last few years. Profits to GDP are at about 6%, which is one of the highest that we have seen in a long time for India. I think the all-time high was 7 or 8%. So we are in a very good profit to GDP trajectory. Even margins are high. So for earnings to kind of move ahead from here on, you require top-line growth. Translation, you require GDP growth rate. And our GDP growth rate, unfortunately, today is less than 10%. The nominal GDP growth rate is less than 10%. And that's really where the challenges come in. Having said that, all the other points that I mentioned, today you're going to have we have very, very strong bank balance sheets. And they're all willing to lend. The credit cycle usually starts when there is opportunity for the balance sheets of banks to start lending, not the other way around. Not when there is demand for credit, but rather when there is an opportunity to lend. So the balance sheets are strong, interest rates are coming down. I think the credit cycle will begin again, and that will mean the GDP of the country will accelerate, and that could translate into further earnings growth as we move forward. Like I said, left to our own devices, we would be very, very strong market, but I think there are global challenges to contend with.
All right. All right, Rajesh, hi, good morning. This is Shrishti also joining in. So believe that financials as a space you like on the back of the credit cycle uptake is what you're forecasting. But other than that, Rajesh, which are the other sectors that you like at this point in time?
So I'll just make a nuanced argument there on financials. We have liked financials quite a lot, although I've taken some money off the table. That's because what's happening is I think you're going to see a consolidation of profits, at least for large private sector banks in the current financial year. If interest rates come down, what happens is their asset book is really getting repriced lower. They will adjust over a period of time with their deposit costs also kind of coming down, but the profit growth will be probably, muted, I would say, in the current financial year, only to accelerate next financial year. So my sense is, given how well financials have done, they are the only conspicuous sector which is at a new high. My sense is that you should lower your expectations on certain private sector banks. To answer your question, I'm very excited about telecommunications, life insurance companies, utilities, digital businesses, so on and so forth. And like I pointed out, with the improving credit trajectory, I think consumer discretionary, like automobiles or some other consumer discretionary items, are also emerging as buy themes for me.
Why do you like life insurance? Growth is just not there. There is no growth.
Sorry, why do I like IT? Did you
No,
say?
no, insurance. IT
Insurance.
में भी growth
No.
नहीं है, चलो दोनों में growth नहीं है.
नहीं, लाइफ इंश्योरेंस में ग्रोथ है. So fortunately, I'll tell you why I like life insurance. Look, this is a very consolidated business, right? You can see that the top 4 companies which are eating into the LIC's market share are all banks, right? And they are definitely kind of doing quite well as far as both APE, the insurance premiums are concerned, as well as value of new business, which is really, you can call it profits. Both those fronts, they are doing well. The valuations have come down because of severe concerns on regulatory aspects. So surrender value, all of those aspects. There were challenges on bank assurance, whether that channel will get kind of cut for some of these banks. All of those regulatory concerns are now behind us. So my sense is that as you move forward, both your APE as well as VNB, which is top line and bottom line, are going to move very well. And by the way, the valuations have come to very attractive levels. You look at these stocks, they've not done too much over the last few years. So my sense is with the regulatory overhang coming to a certain point, which is to an end point, now my sense is growth will accelerate for these companies again. And like I said, there's enough market share to grab from LIC as you move forward.
What about general insurance, health insurance? A lot of listed stocks are there now. FDI has been approved, so maybe there could be some triggers and M&A there.
So I'm a little less enthusiastic about general insurance, although I like some companies there. But I would say less enthusiastic, especially about healthcare, given some of the challenges that SAHI, which is standalone health insurance, face. So less enthusiastic about that. Also on the general insurance, which includes motor insurance, etc., I think it requires motor volumes to do well, which I think will as you move forward. And third-party insurance needs to be repriced as you move forward. Having said that, these are all very good franchises, and over a long period of time, they will do well. But in the context of general versus life, I would say my money at this moment is on life insurance.
As you look into the future, Rajesh, where do you think this market P multiples would be challenged? Where growth could disappoint, margins could disappoint, or pure market re-rating of other sectors could have impact on those P multiples? Where is that fat in the market in terms of multiples?
So I think as far as P multiples are concerned, I think the challenges are not as much domestic. It will become more challenges globally. We are probably at 19 or 20 times 27 earnings as we speak. But look, one of the concerns that is emerging globally is the cost of capital. The mother market is really America, and the long-term yields are going up. Now, fortunately, they are at 4.5 for 10 years and 5% or thereabouts for 30 years. But what if they were to go higher? That's your risk-free rate of return. If your risk-free rate of return goes up, that too in dollar terms, then the ask for equity IRR moves up. As interest rates actually go up, what is supposed to happen is P's are supposed to come down. So my sense is that the risk for P ratios to expand or contract are really a function of how you would see global cost of capital moving. At this moment, it is not at crisis level. While they're going up, they are not at crisis level, and because of which our markets are not responding in any dramatic manner. But if that were to go up significantly, I think that would become a headwind to rising price earnings ratio as you move forward.
You said that you've taken some chips off the table in private banks. Why would you do that? Because for PSU banks, the numbers have been okay. I look at SBI, good numbers. I look at BOB, not so great numbers. You are selling a sector where growth, I think, has been quite decent.
No, Nikunj, you're right. I am not saying that I'm bearish on private sector banks. I'm just taking some chips off the table, given how well they have done. And my outlook for these profits of these private sector banks, especially some which have done extremely well, are slightly muted for financial year 26. They will re-accelerate into 27. See, 50 basis points of interest rate cut has already happened. A lot of the private banks that we speak to are assuming another 50 basis points. some economists actually believe we are in such a deflationary environment that actually you could have a much higher cut than even the another 50 basis points that we are envisaging. If that were to be the case, what would happen is that it would take time for banks to adjust their asset books, because asset books will get repriced very, very quickly because they are dependent on external borrowing rate. So if repo rates were to go down, then they'll have to readjust their asset book quite fast. And which means that their NIIs the net interest income will not grow at an attractive rate. Given that credit costs may tick up a little rather than down as you move forward, my sense is that the profit growths will be anemic for the next year, which is financial year 26, only to reaccelerate in 27. But my sense is, given that these are now at 2.8, 3 times price to book value, my sense is it's good to take some money off the table and allocate it to other places where I see greater value.
Rajesh, so good chatting with you today. Thanks as always for your time.
Thank you.
If you like this video, then like, share and subscribe to ET Now.